Hey there, Nomads. Welcome to the very first episode of the Nomad Show, where we uncover the secrets to making money online without ever showing your face. In this first episode, I'd like to talk about the pitfalls of options trading that I've experienced firsthand, especially as a beginner options trader. So the first one is to do with theta. So options contracts, if you don't already know, have the Greeks. So different Greeks tell us different information, and one of it is the theta, which represents the time decay. So whenever we trade options, we need to understand that there is an expiration date to this contract. Right, so today, as of the recording, is 2nd of August 2024. So for contracts expiring today on this very Friday, they are going to have a very high theta, right? Because it is within today that we see whether the contract has an intrinsic value or not, right? Whether they will be exercised for a call contract if the strike price is below or at the share price, or for a put contract if the strike price is actually below or at the share price. So it's important to understand that for any contracts that are very near term, the theta is very high. So in that case, what happens is if we are the buyers of the contract, then we are chasing against time, right, in order to make a profit off our contract, right? So for instance, if we were to buy a contract that expires on this if the shares move in our favor, then the contract is very likely to move aggressively, right, in terms of the price, and we are able to make a huge profit, right? But conversely, if the stock goes against us, then we'll see that because of the time decay that's very fast, and also because we only have a few hours to see whether this contract is going to be worth something or to be worth nothing at the end of the market, then it is going to be very volatile, right, in terms of the share price or in terms of the option price. So in that case, if someone were to want to just focus on the high profits, right, so they think that because the shares are likely to move in this direction and we would like to take a contract that is probably going to favor this direction for the stock price, and later on to find out that we are sorely mistaken, then it is very likely that we will lose everything on that contract, right? So it's important to know that the longer term the contract that we buy, then it is safer for us as a buyer. Conversely, if you are the ones selling contracts, so if you are selling the contracts, then there's another thing. Time is on our side. So if we are selling a contract that expires today, then at the same time, because this contract only has a few hours before it expires, then there's a very high chance that this contract is going to expire worthless, especially if it's out the money, and there's only a few hours for the stocks to move favorably, right, for the buyers. So in that sense, it may be safer. We use the word may, right, because it's not always the case, but it may be safer for a seller to sell this very short-term contract, right? Especially if they have the cash to sell a covered put, or they have the shares to sell a covered call, right? So in that case, they will be able to buffer against any losses, right? Should they need to buy the shares or to sell the shares, right, depending on their position. So I would say understanding theta is important, not to just look at the profits that come with trading very short-term options, but also to understand where our losses could come from in terms of trading very short-term options. So the second mistake I would say is to not understand the underlying stock. So very often we may not be always very in tune between the stocks and the option contracts. So basically option contracts, they track the movement, right? They track the price of the underlying asset. So today, if Tesla stock is rising in price, then the Tesla call options are also going to rise in price, right? And if it falls, then Tesla put options are going to drop in price. If we are not aware of what the underlying stock or the underlying asset is, what's happening to it, right? Such as an adverse news affecting the company, or whether there's a favorable news, then we may just blindly trade the contracts and not know what we are doing, not know what's happening to the assets, and in that case we may suffer when the contract price actually starts to decrease, right, and we start to have all these losses. So I would say before we trade the contracts, we need to be very mindful of what the assets are that we are trading, right? So personally, if I'm trading the stock options, then I will need to know what the stocks are. So if I'm trading Tesla options, I need to know what the company is doing, what's happening. I need to read the news. I need to see if there's any update so that I'm aware of what could happen and what is happening, so that I trade this with this piece of information in mind, right? So that I will not be taken by surprise when the option contract actually moves unfavorably against me. Third mistake I would say is over leveraging. So many a times we are not mindful of how we plan our whole portfolio. So we may have a certain amount, such as $10,000, $20,000, and we may go very heavily into one position, right? So we may be long Nvidia, right? Because in 2024, Nvidia has actually risen aggressively, right, since the start of the year. So we may have 80% of our positions in Nvidia calls. So in that case, we become over leveraged, right? So if Nvidia is now starting to drop, right, then we find that we are suffering a big loss, whether it is a paper loss that has yet to be realized or whether we have realized the losses. That is still a big loss nonetheless. And we can see that in that case, we become demoralized because we are not able to recoup our losses, or we feel that we have taken a big loss and we may not be able to trade successfully. So it is important from the start to know what percentage we can allocate to any shares or in that, because generally the stock market may have a certain correlationship, right? Like the major tech stocks may be moving up together, or it may be moving down together generally, right? Except where certain companies have certain company-specific news that affects it differently. Otherwise, if we are looking on a general day, right, where the general sentiment is bullish, then everything may fly, right? Or where everything is bearish on the day in terms of sentiments, then all the stocks may actually. So in that case, if we take all the core positions, and especially if you're taking all very short term, right, such as buying a next week expiration, or even if it's just 1 month expiration, which is a very short period, then it may be likely that we are still going to see a big loss on our portfolio, because everything is moving against us at the same time, coupled with the effects of time decay that we mentioned in the first point before. This will again lead to a very big loss, right? And always remember that losing 50% means that we have to gain another 100% in order to recoup our losses, right? So it's important from the start to avoid over leveraging so that we keep ourselves safe. So mistake 4 is to not understand the volatility of the stocks. So this had been the case with me when I was trading stocks that were having earnings announcement the following day. So with companies that have an earnings announcement in the next few days, the contracts will, if you look at the contracts, you will see that the implied volatility is actually on the higher side, right? So for a stock that has a usual implied volatility of 20-30%, right, or even up to 50%, you may see that the IV now, because of the earnings, it has jumped up to maybe 200%, right? So what this means is the contract also prices in the volatility. So because there's a chance that the stocks may move suddenly, aggressively, in both directions, the contracts will become more expensive, right? To account for the possibility that it may have a favorable move all of a sudden. So the contracts, in short, become more expensive. As a buyer of the contract, take a position 1 or 2 days before the earnings, then the contracts will be priced very high. So we're going to buy the contracts at a very high price. But after the earnings announcements have been made, the IV is going to drop, right? So traders usually call this the IV crush. So that means that the IV, the implied volatility of the contracts, will suddenly go down a lot, because now that the earnings have been made, people know what the performance of the company is. They are more likely to go in a certain direction, right? So if, let's say, Meta is announcing something favorably, then people more or less will be trading the stock more aggressively on the long side, right, instead of on the short side where they sell the stocks. So in that case, because of the IV crush, the buyers will see a huge drop in their option pricing because the contracts are worth less with the stock being less volatile. So in that case, it's going to affect the buyers as well, right? So conversely, if we are the sellers of the contract, then the IV crush will work to our benefit, our advantage. So because the contracts are now losing in value very rapidly, so if we sold it at a certain price, right, we can now buy it back at a cheaper price. So that would be a profit to us, okay, depending on which side of the position that we are on. Now, mistake 5 that I made personally was not having a trading plan, right? So a trading plan, it is similar to point 3, right, where we talk about over leveraging, but trading plan here, apart from having the portfolio, how much to allocate to each position, it is also about where we enter and exit a certain position, right? So we need to be clear before we enter the market whether we are taking short-term positions today, or where we are entering and exiting the position within the day itself, or we are taking a long-term position. So if we want to take a longer-term position, then what are the steps that we do? Right? So we could analyze the company, know the fundamentals. We could look at the stocks, the stock charts, right, and see the technicals, and then decide to enter when it comes to a certain price, right? So that would be our approach. Conversely, if you're taking a short-term position, then we may be very focused on just any news that comes up today that could affect the stock price, and we rely heavily on the technicals, right? So we look at the chart. But at the same time, because you are trading short-term, right, it's very volatile and everything has to be done within the day itself. So there's a lot of decision making, and with that, a higher stress level. We need to know exactly where on the stock, let's say on the chart itself, that we are entering the position at, and at which point do we exit. Right? This will be true for taking profits, right? When we have some profits and we want to exit them, or even for stop loss. So there must be a point set where we know for sure that we are going to exit the position, so we can bear this amount of losses rather than the losses escalate to a bigger amount. So we set a stop loss and we will exit the position at that point no matter what. So even if after we make the stop loss and the stocks actually now turn favorably against us, and we would have made a profit if we had kept the position still, it is nonetheless a trader's discipline to have a stop loss in place and exit the position once the stop loss is hit and not look back. So all this takes a certain level of discipline. Okay, so there you have it, Nomads. These are the 5 mistakes that I made personally as a trader. So I hope that you guys learned something from this sharing, and I'll be back with the next episode. See you guys.